In January 2021, a group of people on Reddit decided to do something that wasn't supposed to be possible. They took GameStop, a dying retailer that hedge funds were betting against, and drove its stock up over 1,000% in days. Hedge funds lost billions, Robinhood stopped people from buying, and for about 2 weeks, the entire financial world lost its mind.
On the morning of January 28, 2021, millions of retail investors woke up, opened their brokerage apps, and found something strange. They could sell their shares of GameStop, but the buy button was turned off. This chart shows GameStop's stock price over the preceding weeks. Over a matter of days, the price rocketed up over 1,700%. The sudden surge inflicted massive multi-billion-dollar losses on institutional hedge funds that had bet heavily against the company. Within hours, public outrage flooded the internet. Politicians from across the political spectrum accused the brokerages of manipulating the market to protect Wall Street elites from further losses. This raised a massive question. Did the brokerages illegally rig the game to save struggling billionaires? Or did they pull the emergency brake to stop a total mechanical collapse of the financial system? That single morning stripped away the idea of a level playing field. When the system is pushed to its absolute breaking point, we have to ask who the market is actually designed to protect. Before the chaos, GameStop was just a standard video game retailer, anchoring strip malls across the country. With consumers shifting to digital downloads, Wall Street saw a dying company and placed massive bets against it. Institutional investors used a strategy called short selling. They borrow shares of a stock, sell them at the current price, and wait. If the stock price drops, they buy those shares back for cheaper, return the borrowed shares, and pocket the difference. But users on the Reddit forum Wall Street Bets noticed a mathematical glitch. Hedge funds had gotten so aggressive, they had shorted approximately 140% of GameStop's publicly available shares. They sold more shares than actually existed. To exploit this, retail traders started buying the stock, pushing the price higher. This forced the short sellers into a panic. To close their losing bets, the hedge funds had to buy shares. Their mandatory buying drove the price up even more, creating a continuous loop known as a short squeeze. A crowdsourced internet forum used the market's own mechanics to trap institutional trading desks. The retail traders completely flipped the power dynamic of modern finance. To understand why the brokerages suddenly pulled the plug, we have to look at the hidden plumbing of the stock market. When you tap buy on an app, the trade doesn't settle instantly. It goes through a central clearinghouse called the National Securities Clearing Corporation, or NSSC. Because it takes a few days for the actual shares and cash to move between accounts, brokers are required to post collateral deposits. They have to lock up their own cash in the clearinghouse vault to guarantee the trades won't fail during that waiting period. On January 28th, GameStop's extreme volatility triggered an automatic formula at the clearinghouse. Before the market even opened, the NSCC demanded a $3 billion collateral deposit from the brokerage Robinhood. Robinhood didn't have $3 billion. The company faced a brutal ultimatum. If they failed to post the collateral, the brokerage would default and collapse entirely. To survive, they negotiated the requirement down, but the clearinghouse demanded a steep price. Robinhood had to stop its users from buying the volatile stock. The stock market's underlying infrastructure functioned exactly as it was designed, prioritizing systemic survival over retail access. In the immediate aftermath, the major hedge funds secured multi-billion-dollar emergency cash infusions to survive their bad bets. Meanwhile, without the ability to buy, the stock plummeted, and retail investors who arrived late to the rally suffered devastating financial losses. The massive disruption demanded political answers. Regulators organized congressional hearings, pulling the highest-profile figures of the saga into Washington's spotlight. Robinhood CEO Vlad Tenev faced highly skeptical lawmakers. He had to defend the sudden trading halt by explaining the obscure technical collateral requirements of the clearinghouse to an angry public. On the other side of the screen sat Keith Gill, the amateur investor who helped spark the phenomenon. Testifying from his gaming chair, he represented the decentralized army of internet traders who had taken on Wall Street. While the GameStop saga proved that retail investors can disrupt Wall Street, the resulting halt revealed a system where the foundational rules of clearing and capital are built to prioritize the stability of the house.
GameStop didn't change Wall Street, not permanently. But for a brief, chaotic moment, a group of ordinary people exposed something finance professionals have always known. The market is, on some level, a game. And games can be played by anyone. Subscribe.